to share screen.
Thank you for the very warm welcome and good evening, everyone. I hope you all are doing safe and well. I understand it's an 8 p.m. call, so we'll try to keep this call engaging and address the key issues of the broader market outlook and speak to you about an exciting opportunity that we bring to you via RHB in Malaysia. So if you could just have the slides, thank you so much. Perfect. So as was mentioned in my brief introduction, my name is Rohini and I am from JP Morgan Asset Management. And I'm here to speak to you today about the RHB iGlobal Sustainable Disruptor Fund, for which JP Morgan is the investment advisor. This fund seeks to invest in what we believe are the long-term disruptive themes of the world. The fund is Sharia compliant and also takes into account environmental, social, and governance factors. So before we speak about the fund, let's deep dive and speak a little bit about the broader market outlook that we have. So if we go to the next slide, I want to start our discussion today by addressing the elephant in the room, that is COVID. One more slide ahead. Yes, thank you. So I realize I'm speaking to you today from Singapore, where we are in the middle of a lockdown of sorts. And I know you two are in the midst of a full MCO in Malaysia. But what is happening in the developed markets, especially countries like the US, is a very different situation. Life is nearly back to normal. And there are two key reasons why this is happening. First is the very successful COVID vaccine rollout that has taken place in the United States as well as Europe. So on the slide that you see on your screens, on the left, we have the daily increase in cases around the world, which has dropped significantly. And US is shown in blue, while Europe is shown in purple. And this drop in cases has happened because of the very successful COVID vaccine rollout. On the right-hand side, we have the percentage of the population that has received at least one dosage of the vaccine. And we can see that UK is leading the developed world, closely followed by the US. In fact, according to our own analysis, United States has already reached a state of herd immunity because 70% of the population has either gotten the vaccine or has been infected in the past and developed some natural immunity. So the first reason is the very successful COVID vaccine rollout. And the second reason for life being back to normal in these markets, especially in terms of consumer spending, is because of the role policy support by governments has played. In particular, I want to mention the US. Joe Biden has announced nearly $6 trillion in fiscal stimulus since he has come into position. And the 1.9 trillion stimulus that has already been passed meant that earlier in the year, every American received $1,400 in their bank account. So the two reasons why life is back to normal in these markets is the successful COVID vaccine rollout and the very supportive fiscal stimulus. So what has all of this led to? For that, let's go to the next slide. In our view, we expect significant economic recovery to take place over the next several quarters. And this will be driven by countries like US and the Europe. So here on your screens, you can already see how this recovery is taking place. And it's being driven by consumers. All that stimulus that governments had provided means that consumers today are looking very healthy in terms of net savings. And as things normalize, a lot of that pent-up demand will be fed back into the markets. And this will create a scenario of significant growth. So here you can see that US is already back in business. There is a pickup in hotel occupancy, travel, mortgage applications, and even restaurant seatings. So I mentioned that US is expected to lead the economic recovery. And to give you some numbers, US is expected to grow at a rate of 6.5% to 7% this year, which is actually the fastest rate in nearly 40 years. Now, US is a $22 trillion economy. And even if we conservatively assume that growth will be about 6%, it means that US is expected to add nearly $1.3 trillion of additional GDP in 2021 alone. For some context, that is the combined annual GDP of Malaysia, Singapore, and Philippines. So in 1 year, US will add the annual GDP of all these economies combined. So what does this economic recovery mean for businesses? For that, let's go to the next slide. And here we have the earnings growth recovery that is expected in the developed markets. And by JP Morgan's own proprietary expectations, we are expecting a pickup of about 26% in earnings in 2021. And this won't be short term. We expect this to continue in 2022. Hence, in the coming quarters, we expect equity returns to be largely driven by the strong earnings growth recovery that we expect to play out. So the question I often get from clients is, can we see a repeat of last year's strong equity performance? For that, let's go to the next slide to see how does the current equity market performance look in terms of previous bull markets. So here I have a chart which shows the various bull markets in the US over the last 60 years. It shows you the time period of a bull market and it shows you the strength of the bull market. And in the red circle, I have highlighted the bull market that we are currently experiencing. So you can easily see that this bull market that we currently are in is the youngest and perhaps the shortest in terms of price returns. So far, in about 12 to 14 months, we've seen about 80% of returns. On a standalone basis, that might look like a lot, but when you compare it to the previous bull markets, that is those huge green mountains, you will see that it is relatively weak and young. So the question is, do we expect this bull market to continue? Never say never, but if we start to assign the things that are happening, the huge stimulus that is being pumped in, the ongoing QE, US expected to grow at record rates, the highest in nearly 4 decades. The probability of this bull market ending soon is low in our opinion. But I must highlight that you will notice that no bull market is a straight line. So yes, the direction is upward, but you'll notice that the bull market line is jagged. What that means is that there will be volatility. So the volatility that we have seen so far is par for the course. But we think that the current bull market still has legs to continue to run, although there will be some volatility. So to summarize everything I've said so far, our market outlook remains bullish for equities, especially in developed markets, because we expect significant economic recovery to take place in the coming quarters. At the same time, we do think there will be volatility. It will not be an easy market, whether it's COVID-related concerns or inflation expectations. We expect earnings to not be uniform. Hence, investors need to take an active approach to identifying the winners of tomorrow. And our solution to this volatile but exciting market environment is the fund that I'm here to speak to you about. If we go to the next slide, that is the RHVI Global Sustainable Disruptors Fund. So our solution is to focus on themes that are structural megatrends and will survive through varying macro environments. So on this slide is a brief summary of what we are investing in, how we are investing, and why us. So when we speak about the what we are seeking to invest in are disruptors. And disruptors means companies that are beneficiaries or winners of themes that we believe have long-term growth potential and will survive through varying macro environments. Today, there are 5 themes that are driving our portfolio, and we'll speak a lot more about this in the next minutes. But our fund is not just looking at technology. So there is a lot of talk about tech. So tech is one of the themes that we look at, but it also allows clients to take parts in trends beyond technology. So trends like healthcare innovation, energy revolution, digitalization. So once we decide these themes, we find stocks that are best positioned to capture the potential of the theme. So if you invest in a tech fund, you're only getting exposure to the tech theme. But our fund also allows you the flexibility and diversification across several themes that we believe have high growth potential. So as an investor, you don't have to go out and find these exciting themes. The fund manager does that for you. So that's the what. Then is how we are investing. And here I want to highlight 2 key aspects of this fund. First is our focus on ESG, which is environmental, social, and governance factors of a company. And we pay attention to this because we have seen proof that companies with high ESG score tend to provide higher returns with lower volatility. Hence, ESG is one of the factors that we consider during portfolio construction. And the second key aspect of our investment process is the unconstrained approach, which in other words means highly flexible approach. So our starting universe is the Dow Jones Islamic Index, which has nearly 3,000 stocks. And from there, we use an unconstrained approach, which means that we do not care about the size of the company or the sector the company falls into or the geography or country the company falls into. Our focus is simply on finding 30 to 50 best ideas that will provide attractive returns from a medium to long-term perspective. So this flexible approach to finding the most innovative themes is what differentiates this strategy. And finally is why us? And for that, I do want to speak about what JP Morgan intends to bring to this strategy. If we go to the next slide, there is a quick snapshot of our capabilities. And I think this is particularly important for a fund like this, which is a global fund seeking to provide investors access to best ideas. So we are present on ground in these markets. We have more than 370 equity professionals all around the world. And we have a $150 million annual budget for equity research alone, which emphasizes our focus on quality research. Hence, what we are investing in, which is the disruptors, how we are investing, that is our flexible approach, and our capabilities is what differentiates us. And this is reflected in the strategy's performance, which is on the next slide. So the RHB fund was launched earlier in this year, but the underlying strategy that is being provided by JP Morgan is not new. Its inception goes back to October 2019. And you can see that since inception, the fund has given more than 92% cumulative returns, which means it has outperformed its index by nearly 40%. And in particular, the last few months have been volatile for growth equities at large. But you will note that this strategy has continued to hold up well and provide positive returns. In 6 months, the strategy has given more than 24% returns. And this is in huge contrast to other disruptor strategies in the market, which have been very volatile in this background. So hopefully, this gives you an idea of a brief overview of what we intend to bring to our clients in Malaysia. But now let's take a step further and deep dive into the themes that we currently invest in. So here are the 5 themes that we find interesting at this point in time. And I must mention that given we are a flexible strategy, we also have the flexibility to add on new themes that we think could provide attractive returns from a medium to long-term perspective. So today, while the focus is on these 5 themes, maybe when I speak to you 1 year from now, there could be more themes added onto this portfolio. So let's speak about each of these themes, starting with digitalization. I think digitalization is the one theme all of us on this call are well acquainted with, because digitalization, or in other words, technology, has transformed the way we live, the way we work, the way we socialize, especially over the past 1 year. Some of the trends that we find interesting within digitalization are artificial intelligence, automation, gaming. And one of the key ways in which we are playing the digitalization theme in our portfolio today is by our holdings in semiconductor companies. So why do we like this space? For that, let's go to the next slide. It's this reason. One slide before, please. Here is a picture of semiconductor chips. And these chips are a key component of cloud computing, artificial intelligence, machine learning, and even gaming. So for some context to the power of this chip, let's speak a little bit about what's happening in the world today. So the amount of data that is created doubles in the world every year. Today, there are 4.4 billion people who own a smartphone, and each of them creates 1.75 MB of data per second. And add to that is the data that is required for artificial intelligence, streaming, content, emails, and other sorts of industrial data. And all of this data requires storage and memory, for which we need these chips. If you can just go to the previous slide. So today, we are dealing, to add to this broader positive outlook that we have for semiconductor chips, today we are dealing with a global shortage in these chips, which has been caused by COVID-19 lockdowns and a new surge in demand driven by the changing habits fueled by the pandemic. So this, as a result, is benefiting key producers of chips, as they're receiving more orders and are able to exert pricing power. So hopefully this illustrates why we like playing the digitalization trend via our exposure to semiconductor companies like TSMC, NVIDIA, ASML. In fact, ASML Holding has reported an increase in nearly 250% year-on-year profits because of the global chip shortage that is ongoing. So that was the theme of digitalization. If we go to the next slide, let's speak about our second theme, which is financial evolution. And this perhaps comes intuitively to most of us on this call, because at some point or the other in the past year, we would have used our mobiles for payments or our e-wallets to make some sort of e-commerce transaction. So even though this is a concept that we are rather familiar with, you will be pleasantly surprised to know the penetration rates of financials, of these online financial services, is still relatively low in the world. For instance, in the US, which is a leader in mobile payments, 70% of the population is still largely using cash for payments. So this shows the scope for tremendous growth in this space. And we are positioning in stocks like Adyen. Adyen, for which you see a logo on the screen, is a Dutch company which is a payments platform for many companies like Spotify, Uber, Booking.com. So when you actually make a transaction on Spotify or on Uber, you're actually interacting with the underlying Adyen service. Then there is also MasterCard, which in fact is our largest holding today. MasterCard is benefiting from that structural growth in movement, in shifting from cash to card transaction, as well as the increasing penetration of e-commerce. In 2020, MasterCard's revenue suffered because one of the key revenue drivers for them is international cross-border fees. And because people were not traveling, their revenue suffered. So we were able to actually get MasterCard at attractive prices because of this short-term hindrance that it was facing, because eventually we expect cross-border travel to pick up. So hopefully this gives you an idea of some of the names that we find exciting within the financial evolution space because of the tremendous growth that we expect in e-commerce in the coming years. So if we go to the next slide, let's speak about the theme called feeling good. Next slide, please. Yes. So this trend encapsulates the concept of new consumption. So what does new consumption mean? It essentially refers to changing behavioral consumption, whether it is what we consume or how we consume. An intuitive example of feeling good would be consuming food via delivery apps. I don't know about you, but sometime in the last year, in fact, thanks to last year, I have become over-reliant on my Food Panda app for my daily food. And Delivery Hero is a company that owns delivery companies around the world, including Food Panda. And that is an example of one of the holdings we have in our portfolio that is benefiting from this feeling good theme that is changing behavioral consumption. I also want to speak about Country Garden Services, which is the logo on the extreme left. This is one of the largest property management companies in China. Now, you will be wondering, why is this within the theme of feeling good? It's within feeling good because of the value-added services that Country Garden provides to its residents. So some of the services that it provides are nannies or care for elderly people in the house. So these are some of the value-added services that people in China who give high value to. So that's why we like Country Garden Services. But one of the other reasons that we like this company is because it is part of our diversification away from areas that are receiving high government scrutiny. So in China, there is a lot of focus on tech companies, and China is coming up with more and more regulations for these tech companies. But one of the spaces that the government is actually pro, or in terms of relaxing regulations, is this property management space. And Country Garden Services will benefit from the government initiatives within this space. So we like this company because of its high expected earnings growth, because of its strong balance sheet, and because we expect it to directly benefit from government support. Another example of feeling good is our position in a company called Zoetis. Zoetis is a market leader in pet care. So you might be wondering, why does a disruptor portfolio have a company within pet care? For that, let's go to the next slide, where you can see some interesting statistics when it comes to pet ownerships. So Gen Z and millennials today, that is the younger generation born largely about 1990 to 2000, are driving the trend of pet ownership massively. In fact, 45% of pet owners today are millennials, and this number is continuing to grow. So Zoetis is well positioned to capture this growing opportunity set. So hopefully this gives you an idea of the very interesting and different companies that we have within this theme called feeling good, which captures changing behavioral habits. Now let's speak about the next theme, which is healthcare innovation. There is a lot of innovation happening within the healthcare space. And if not anything, COVID has been a great reminder of the fact that we need to pay attention to innovation within healthcare. So some of the names that we find exciting within this space can be seen on your screen right now. Dexcom. This is a leader in continuous glucose monitoring market. So what it has is a small device that you wear under your skin, and it monitors your sugar levels throughout the day and lets you see trends in terms of spike and alerts you when your sugar is high or very low. So this is a great technology for diabetic patients who also happen to be high risk for COVID. So during this period of COVID, the adoption for this remote technology has been massively accelerated. And we do think that there is great potential for this technology in the coming years as well. Another example of a company that we find interesting is Intuitive Surgical. What Intuitive Surgical does is that it creates robots for surgeries. In fact, it is the first company to have gotten a medical robot signed off for soft tissue operations. So what that means is that today there is just 5% of operations in the world being done by robots. But by 2025, it is expected that this number will increase to 25%. So a huge opportunity set. And a name like Intuitive Surgical, which has already gotten the FDA approval, will directly benefit from this space. So hopefully this gives you an idea of some of the exciting names that we find within healthcare innovation, a trend that we think has high growth potential in the coming years. Finally, let's speak about the last theme that we currently find interesting, which is energy revolution. Now, clean energy is picking up all over the world, whether it's due to regulations or social changes and greater awareness. In fact, China, which today accounts for nearly 40% of all carbon emissions in the world, 40%, one country, has declared that they will go carbon neutral by 2060. So we believe that as a result of all these government initiatives, a lot of work is going to happen within this clean energy space, which will create attractive investments opportunities. In specific, I want to speak about one of the underlying themes within energy revolution that currently is of great interest to clients. And that's on the next slide. Here is an image of an electric vehicle. And we all know about a company like Tesla. But we think that investing directly in brands like Tesla is not the only way to play this theme of electric vehicles, because some of these names, like Tesla, look very expensive now. So the way we play the theme of electric vehicles is by investing in the supply chain of electric vehicles. That is what goes under the hood of this car. And one such company is Samsung SDI on the next slide. So Samsung SDI is part of the supply chain of electric vehicles because it creates the batteries that go within these cars. So as the sales for electric vehicles picks up, so will the sales for the batteries that are a key component of these cars. And at the same time, electric vehicle batteries will also benefit from the government initiatives, whether it's China who plans to be carbon neutral by 2060 or Joe Biden, who has put a huge emphasis on green investments. So Samsung SDI is one of the ways that we are playing the electric vehicle theme that falls within our broader energy revolution theme. So if we go to the next slide, hopefully this gives you an idea of how one strategy seeks to give you access to all these 5 growing themes. And as mentioned, these themes could evolve, and in some years, we could have more themes added into this portfolio. And you can also see some of those stock names that fall within our investment universe and are currently part of our portfolio. So now that we've spoken about what we are investing in, let's speak a little bit about some aspects of our investment process. And for that, let's go to the next slide to speak about one of the key aspects of our process, which is the focus on E, S, and G. E stands for environmental, which means things like carbon emissions, climate change. S is for societal. So we're looking at factors like human capital development, safety of workers. And G is for governance, where we are paying emphasis on board diversity and overall ethics of a company. So what you can see here is that our portfolio has an A rating for ESG from MSCI. So ESG is not an afterthought in our portfolio, but it is one of the key aspects that we look into when deciding what falls within our portfolio. And I want to speak about one company that we currently have in our portfolio that shows the innovative ways in which companies are adapting ESG into their processes. And that company is Nike. Now, I'm sure many of us on this call perhaps own a pair of Nike shoes. I surely do. But I'll be surprised if any of you had thought of Nike as an excellent example of ESG practices. So let's speak a little bit more about why we like Nike. So Nike falls within the theme of feeling good in our portfolio because it has been able to adapt to the increasing trend of online consumption. So the changing behavioral habit here is people like to buy things online, and Nike has been able to shift its business model quickly to being largely online. In fact, in 2020, Nike hit their e-commerce target 3 years in advance. And today, e-commerce accounts for nearly 30% of online sales. But we also like Nike because of all of the things they are doing within ESG. So some of their efforts include creating sustainable leather, which they are doing by using scrap materials. Another thing that they're doing is recycling. In fact, over the past few years, Nike has managed to recycle 7.5 billion plastic bottles. One company, 7.5 billion plastic bottles. And they have converted this plastic to polyester, which they use for their shoes and accessories. So Nike is an excellent example of a company that has realized that its customers are becoming more environmentally conscious, and they have adopted these practices, whether it's minimizing their footprint, improving their product innovation, or improving their manufacturing. They have managed to use sustainability as a key growth engine. So hopefully this gives you an idea of some of the very interesting names that we have in our portfolio that we also like from an ESG perspective. Finally, let's go to the next slide to speak a little bit more about the other aspect of our investment process, which is flexibility. And for this, let's speak a little bit more about how our portfolio looks today. So right now, our portfolio holdings can be largely bracketed to two groups. On the right-hand side, you can see some of the names that we consider have been long-term winners, or winners through the whole COVID pandemic that has played out since 2020. And we believe these companies, whether it's Delivery Hero, which I spoke about within Feeling Good, or ASML, which is a semiconductor company that I mentioned, all of these companies are leading players within their thematic spaces. On the left-hand side is the other bracket of companies, and we call these the interrupted growth stories. So these are the companies that were actually challenged by COVID-related lockdowns, but now with reopening of economies, they will directly benefit. So some examples of these recovery stories are names like Uber or Lyft, which fall within our energy revolution theme, because ride sharing is a lot more beneficial for the environment. So last year, with everyone being stuck at home, Uber and Lyft suffered as well. But we believe they will directly benefit as the economy opens up, and it will also benefit from that long-term potential that we see in the ride-sharing industry. Similarly, I spoke about MasterCard, which suffered last year because of low international transactions. But we believe that the company has a strong balance sheet and will be able to withstand this temporary headwind. So hopefully this gives you an idea of the two ways in which our portfolio is positioned today. The cyclical recovery stories on the left, as well as those long-term winners on the right. Now let's look at our portfolio from a different perspective, and that's on the next slide. So here we have three pie charts to show you the thematic breakdown, sector breakdown, and geographical breakdown. And I want you to pay attention to the middle chart, which is the thematic breakdown. Now, I mentioned that technology is one of the themes, but not the only theme in our portfolio. And that, in our view, is a key reason why we've been able to have robust performance. The flexibility to move across themes has helped us to have robust performance since inception. And you can see today, our portfolio has about 38% in that technology theme, but it also has a very healthy allocation to other themes, like Feeling Good, which is about 24%, energy revolution 15%, financial evolution 15%, and healthcare innovation 8%. Then on the right-hand side, you see the geographical split. Now, if you look at any global tech fund in Malaysia, you will see that on average, they will tend to have about 80 to 90% exposure to US alone. Our portfolio, on the other hand, is fairly well diversified, with about 60% allocation to North America, 22% to emerging markets, and about 12% to Europe. So both in terms of themes as well as geography, our portfolio is well diversified. Now, what has this meant in terms of returns is on the next slide. We think this focus on identifying disruptive themes, this flexible approach in terms of, regardless of geography, size, market cap, has led to the strong performance. If you can just go to the next slide. So all these reasons that I spoke about have contributed to this strong and consistent performance that the fund has seen. So since inception, the fund has given more than 92% returns. And in particular, over the last 6 months, which have been very challenging for growth equities, the fund has given more than 24% returns. So in terms of performance, that is a reflection that we have the right process and the right team in place. But when we go a layer deeper and try to see other metrics of the portfolio on the next slide, you will also see how our portfolio has given higher growth, currently shows higher growth, higher return than the index as well. So here you have some of the key metrics that we monitor closely. First is growth, which is reflected by EPS growth. And you can see that our portfolio exhibits higher growth than the index. Then in terms of returns as well, which we are monitoring via a metric called ROIC, or return on invested capital. Yet again, our portfolio has higher returns than the index. Then another key metric is debt to equity, net debt to equity, which essentially shows the leverage that our portfolio has. So you can see that the index has high leverage, but you will note that the metric for our portfolio is actually negative, which means that our portfolio, in fact, today, the holdings in our portfolio today are actually net cash positive. So while the portfolio holdings have high leverage, the holdings within our portfolio are actually cash rich. And finally, in terms of valuations as well, which is on the extreme right, our portfolio is actually slightly cheaper than the index. So the robust performance is one thing, but also in terms of forward-looking metrics, the portfolio shows that it has higher growth prospects, higher return prospects. It is a quality portfolio, and it is cheaper than the index. So hopefully, if we go to the next slide, I'll try to summarize all the aspects that we spoke about today. So we started out with the market outlook, which I mentioned is our view is that we are bullish for equities, especially in some of the developed markets, because we expect significant economic recovery to take place, whether it's due to COVID vaccine rollouts or the fiscal policies that governments around the world are supporting. But at the same time, we expect volatility. So it will not be an easy market, whether it's COVID-related concerns or inflation expectations. We expect earnings to not be uniform. So we think the best way to navigate this kind of a market is by having an active approach towards identifying winners of themes that have high growth potential and will be able to survive different kinds of macro environments. And that's exactly what this RHP iGlobal Sustainable Disruptor Fund seeks to do. One fund giving you access to all these 5 exciting themes. It is ESG compliant and Sharia compliant. And hopefully with that, I have completed my prepared remarks, and I'll pass it to Jason from RHP to speak a little bit more about the RHP fund as well.
Hi, good evening, Malaysian. What I'm going to share with you is the RHP iGlobal Sustainable Disruptor Fund. Yeah, For main features of this fund is aimed to provide a capital appreciation over the medium to long term, by investing in a portfolio of Sharia compliant equities. Of course, this fund is advised by JP Morgan Asset Management, and of course, this is equity fund. So next, right? This fund consists two class, USD and RMH class. This fund launched in Malaysia in January 2021 and available in Fund Supermart platform. So if you need any further information, you all can surf in Fund Supermart. Over to you, Rohini.
Great. Happy to take on any questions, and hopefully my prepared remarks helped you understand a little bit more about this fund and the themes that we hope to provide you access to. I'll pass it back to the moderator for questions.
Hi, Ms. Rohini. Thank you for your presentation. So we have a few questions client has already posted on the Q&A tab. So I'll quickly move on to the first question. So the first question is, how long do you think the hike in the GDP of the US will be sustained?
So, okay, good question. So we think that in terms of the coming 2 to 3 years, there will be, because the whole COVID pandemic played out and US economy suffered, there will be a bounce back in terms of growth. This year itself, we are expecting about 6.5% to 7% growth. But we think even going into next year, which is 2022, and to some amount even 2023, we will see some of that growth continue. But with that said, our focus is not just from a 2 to 3 year perspective. We are trying to find companies that will do well from, say, a 3 to 5 year perspective, regardless of the environment. So yes, the US economy recovering is a great thing in terms of overall earnings growth for the market. But we are trying to find winners of tomorrow that will benefit from the themes that we think have long-term growth potential. So one of the names, for instance, which I mentioned from the US is a name like MasterCard. Now, MasterCard suffered during COVID because, like I mentioned, people were not traveling, and travel-related expenses is a key revenue parameter for MasterCard. So their revenue suffered. Now with COVID, getting more in control, especially in the US and slowly in the larger world, people will start to travel, and that will benefit MasterCard. So that's the short-term, benefit in terms of recovery that MasterCard will play. But we also like MasterCard from a longer-term perspective, because we expect more and more transactions to shift from cash to card. So there is a long-term growth theme that is also driving MasterCard. So there is the short-term story, which is the recovery story. And then there is also that long-term structural growth story, which is that shift from cash to card. So our focus is on recognizing companies that will do well because of these long-term themes that we're seeing playing out. So to answer your question, we think that the US growth story will play out this year, next year, and to some amount maybe in 2023 as well. But our portfolio is mindful of that growth, but it's trying to find companies that will do well from a long-term perspective as well. And MasterCard is a good example to illustrate that.
I see. Okay. Speaking about this fund, so we have a question with regards to the fund investment strategy. So the client asked, this fund investment strategy mainly consists of growth stock. So how do you navigate through the volatility from growth to value stocks?
Absolutely. Great question. So I think for that, let's go to a slide in the deck, which is slide 41. And what I have over here is how growth and value have performed over the past several years. So growth here is shown in purple and value is shown in blue. And what you can see is that year to date, value is outperforming growth. But over the past 4 years, that is 2017, 18, 19, and 2020, growth outperformed value. So out of the past 10 years, 7 years, growth managed to outperform value. But let's look at the years where value outperformed growth. Maybe a year like 2012. In a year where value outperformed growth, even then, growth did give you attractive returns. So in 2012, value was the winner, but growth companies still gave you about 16 to 14%. Again, in 2014, value was the winner, but growth companies gave you about 13 to 12%. And similarly, in 2016, value was the winner, but growth also gave you 7 to 11%. So what I'm trying to say is that there is no right style to play. In some environments, value will do well. In some environments, growth will do well. But value approach, what is value approach? Value approach is essentially there is an intrinsic value of a company. And right now, the company is trading at a discount. So I want to invest in it. But once the company gets back to its intrinsic value, that's the story. But in high growth, we are not investing just for the discount. We are investing for the high growth potential of the company. So my question to you is, the themes that we spoke about, the innovation in healthcare, the shift from cash to card, or artificial intelligence, these themes are here to stay for the next 3 to 5 to 6 to 10 years. So there will be short periods where there is volatility and there is concerns about value stocks doing better than growth. But if you are an investor from a 3 to 5 year horizon, then these themes do have the potential to give you high earnings growth. So there is no right answer or wrong answer in terms of value versus growth. The right approach is to invest in themes that have high growth potential. Hopefully that answers the question.
Thank you for the answer. So we have a question from a YouTuber. So during pandemic, a lot of the tech-based disruptors are being bought and became expensive. So is it still considered expensive now?
Great question. So I think for that, I will go to slide number, I think it's 28, which is about the barbell investment approach. Yeah. So what we did is that we had the way we've tried to approach this, what's happened during COVID is on one hand, we've maintained our exposure, which is on the right-hand side, to some of these companies that did very well in COVID. So a Delivery Hero, which owns Food Panda, everybody was buying food via apps and the company saw phenomenal growth. Or ASML, again, semiconductor company, which did very well. So we are maintaining our exposure to that. But at the same time, we also have been buying names that suffered during COVID. So as a result, their stock prices did not do well. But we think in terms of long-term growth story, that is 3 to 5 years, there is potential for growth. So we were able to buy these names that suffered at a very attractive price. So a name like Uber, everybody was home, nobody was traveling, it suffered. Similarly, MasterCard, which I spoke about. IDP Education, which helps in placements, helping students get placed into international universities. Strawman, which is dental implants. Nobody cared about getting their teeth fixed during the pandemic. People wanted to just stay at home and be away from hospitals. So these kind of stocks suffered. So what we did is we maintained a balanced approach. Now, when you invest in a pure tech fund, you will not have this flexibility. Even when companies are expensive, by mandate, you have to invest in these technology companies. But our mandate is to invest in winners of tomorrow. So if we think some of the winners are looking expensive, we have the flexibility to find other companies that are trading at cheaper rates. So hopefully this gives you an example of the barbell approach that we've had over the past few months. And I think the best testament to how this approach has played out is the performance. So year to date or the past 6 months have been quite tough for some of these big tech names. But if you look at our portfolio, our focus is not only on these big tech companies. Digitalization is 38% of our portfolio. But we are also looking at other themes that are perhaps available at more attractive prices, like Feeling Good or Energy Revolution. So our flexible approach has allowed us to, navigate this period where valuations look expensive. With that said, I will say that, when you largely look, there is a slide I have, which is slide number 45. And the top chart shows you valuations across the world. And very simply speaking, the green dot shows you where we are today. And the blue line shows you the average valuation. And the gray line shows you, the PE across the past 15 years. And you'll see that the green dots are almost always above that blue line. So very simply speaking, valuations across the board look stretched in comparison to historical valuations. So getting a bargain today is difficult because you have to pay a premium if you want access to high growth companies. But if you look at our portfolio in specific, which is slide number 31, on the extreme right, you will see that our portfolio's valuation is actually cheaper than the index. So EV by EBITDA, which is one of the metrics to see valuations. Our portfolio is cheaper than the index, but the growth of the portfolio, which is the EPS growth potential in blue, or the purple bar, which shows you the return potential, all of those are looking higher than the index. So in a market like this, where some parts of the market look expensive, having a flexible and an active approach like ours is the right way to play the market.
I see. Okay. We have another question. Is this fund focusing just solely on the US market?
No, not at all. So if we just go to slide number 29, I mentioned the word unconstrained, which means that we do not care about the geography or the sector or the market cap. Our mandate is to find 30 to 50 best companies that will capture those 5 themes that we are interested in. And you can see that on the extreme right, the result of that bottom-up approach is about 60% is in the US. And then there is a very healthy allocation to emerging markets, which is 22%, Europe, which is 12%. So no, it's not purely a US market. US is one of the countries that we think will lead this economic recovery, which is expected in the coming quarters. But our approach is diversified and flexible. And I will also highlight that if you look at other funds in the market, which are tech funds, they will have 80 to 90% concentration in the US. But we have a rather flexible and diversified approach.
Yeah, I have a question with regards to interest rate hike. So will the portfolio manager rebalance the technology portfolio to other sectors, as there could be potential interest rate hike in the coming year?
Absolutely. Yeah. Got the question. Great question and very valid in today's market environment. So to answer the question on, let's take a step back to try and answer what happens when interest rates hikes happen. How do equity markets tend to perform? So let's go to slide 42, where we've done an analysis to see how do S&P 500 returns correlate to treasury yields. So on the horizontal axis, you have the 10-year treasury yields. And on the vertical axis, you have the correlation of equities to rates. So what you can see is that today we are at about 1.7 to 1.8% in terms of yields. So that falls within that red box that I've made on this chart. And that red box is in the positive territory, which means that when interest rates are rising from the levels that we are today, which is about 1.7%, there is a positive correlation between equities and rising rates. So if interest rates go up, then equities will also go up if we look at historical performance. So there is a positive correlation. So that's what retrospective analysis is showing us, that even if rates go up, equities should continue to do well. But I also want to answer this question from just from an intuitive way. So my question to you is, first let's understand why are interest rates rising. So interest rates are expected to rise because there is economic recovery happening. Or in other words, let's think about a patient who's very sick. And because he was very sick, he was put on the ventilator. But now that he's recovering, doctors are willing to take off the ventilator because he's showing signs of recovery. Sorry for the very dark analogy, but in some way, the US economy is also like that. So when the economy was suffering, the government gave that ventilator in terms of low interest rates. And now that the economy is showing robust signs of picking up, interest rates are expected to rise. So in this context, rising interest rates is because of economic recovery. And do you think a positive economic recovery picture will be bad for the kind of companies that we are investing in? So do you think artificial intelligence or healthcare innovation or electric vehicle companies will not do well because interest rates are rising? The answer is no. So the short-term volatility that happens because of markets reacting to news, in our opinion, is a good opportunity to buy, because the view is that over 3 to 5 years, the themes that we are interested in will do well regardless of the market environment, whether it's rising rates or rising inflation. So yes, on one hand, retrospective analysis, as seen on this slide, shows you that rising interest rates from the level that we are at today is positive for equities. But also when you reconcile with why rates are expected to rise, the prospect for the themes that we are invested in still looks positive.
Okay, thank you. Understand just now you show a slide with regards to the fund allocation. So we have a question with regards whether do you have China in your portfolio as well?
Yes. So China falls within emerging markets. So you could say it's about 15% allocation in our portfolio, 15.
I see.
So hopefully that answers. Yeah.
So do you have any thoughts with regards to the impact of the US-China tensions?
Yes. So the way we are trying to play, again, simply, I know I'm sounding like I'm repeating myself, but these are all short-term news, or, these cause short-term chaos in the market. The point is that, from a 3 to 5 year perspective, a China company that is involved in healthcare innovation will still do well. But the way we reconcile these US-China tensions within our portfolio is that we try to invest in domestic winners of China. So regardless of what happens in the US, these Chinese companies will still do well. So I'll give you some examples. I spoke about a property name, Country Garden Services. That's not impacted by what's happening in the US. Again, another name like even Meituan Dianping, which is involved in food deliveries. It's completely driven by consumers in China and not impacted by trade war tensions. So the way we play this theme, or the way we manage to protect the portfolio from this volatility, is to invest in domestic winners within China. So that's how we are reconciling with this particular headwind.
I see. Okay, thank you for the answer. So now it's 9 p.m. Maybe we will take one final question. Yeah, so let me just scroll quickly. There is 2 questions with regards to bond tapering. So I'm not sure if you can comment on the impact of US tapering on this fund. Yeah.
So I think it's largely similar to interest rates rising.
Yeah.
So I think rate hikes are expected in 2023, and as a result, if our view is that tapering will perhaps start at some point in 2022. Again, I'll come back to that very dark analogy I gave, but the only reason that tapering will happen whenever it does happen is because the Fed believes that the economy is strong enough to not need that extra support. So there might be short-term volatility, but again, the names that we are invested in I've even shown you the cash position of our portfolio. Our holdings are actually net cash positive, which means that even when rates rise, they have enough excess cash in their balance sheet to not require any kind of borrowing. So these are high quality companies that will do well regardless of these macro concerns. So firstly, we do not think tapering is a concern. We think tapering will only happen when the Fed is reassured that the economy is strong, the economy can sustain itself. So we do not think they will rush into it. Number two, when it does happen, it will not impact these quality names because they have strong balance sheets and we're not relying on this government support. So yeah, the answer is that our focus is on companies that have high growth potential because they are investing, they are winners of these themes that we've identified that we think will do well over the next 5 years, 7 years, 10 years, regardless of the macro environment that we are in.
Okay, thanks so much, Ms. Rohini, for the answers. So, ladies and gentlemen, with that, we'd like to end the webinar session for this evening. Thank you all for coming here to listen to our talk with Ms. Rohini as well as, so thank you to Ms. Rohini, JP Morgan Asset Management. Thank you to Jason, RHB Asset Management. Ladies and gentlemen, this fund is actually available on FSM One platform. So if you have any questions with regards to these funds, you can actually drop us an email to our client investment specialist at investhelp.my@fundsupermart.com. Okay, so hope everyone stays safe and we'll see you in our upcoming webinars. In July, we have several recommended unit trust webinars lined up. So we're excited to actually organize and also run the events later in July. So stay tuned for that. And with that, thank you everyone and stay safe.
Thank you everyone.
Goodbye.
Stay
Goodbye.
safe.